Hello everybody and welcome back to another temporary lecture. In this one I'm going to be going over how to spot liquidity on a chart. As previously mentioned, I mentioned that every high and every low in the market acts as a liquidity pool. And the reason is because we learned that liquidity is the transferal between funds from one trader to another. And so that is in the form of a stop loss essentially. And so before showing you guys how to spot it on a chart, I need to first teach you guys what support and resistance is. And so what support and resistance is a retail ideology where if price has touched a specific level of price multiple times, then you could draw a subjective line. And if price revisit that line, then it will either support, meaning supporting higher, or it will resist or reject. So reject lower, resist lower. And that's why it's called support and resistance. And so I'll just draw some quick examples. So here, let's say you had price look like this. Well, in the world of retail, there's once again something called support and resistance. And so there's an ideology where you can draw a subjective line where price has respected it multiple times. And once again, it's very subjective. So everyone draws usually a different trend line on their chart. However, whenever there's a very clean trend line, meaning price just respects that line over and over again. And so if I were to project this out in time even further, when price trades back down to here, this line, what the retail crowd or uninformed money is expecting from price is that it will support from this level and continue to buy higher, right? And so that's the ideology that they have. How we like to look at these kind of trend lines is we look at it as liquidity. And so the reason we can look at this as liquidity is because if the uninformed money or dumb money is looking to buy at this trend line, for example, so let's say they buy here, they're going to put their stop loss either below this trend line or they're going to put it below the previous leg of price. And it's just a typical thing that traders do because this is taught in books and stuff like that. And it's just 95% of the crowd is they know what support and resistance is. So we like to look at these specific lows within a trend line as liquidity. And so whenever there's liquidity on the lows of price, we call it sell side liquidity. Vice versa, if we flip this around, right, then people would be putting their stop losses either right above that trend line or they would put their stop losses at the previous high. And so we'll call it buy side liquidity whenever it's on the highs. And you can start to see why price will draw to these levels, and it's because there are lots of orders resting above either the trend line or these previous highs. And so if, let's say, everyone keeps selling every time it touches this line that they subjectively drew, then that would build up a lot of orders, right? And so if institutions are trying to make a lot of money, then that means they need a lot of liquidity as well. And so with that logic, they will target these orders that are likely to be there and run price right through that trend line, ultimately into all of the liquidity, right? And so I have a cleaner diagram that I'll be showing you guys now. So here is a quick little example I've drawn out on the chart. So you can see here that we have, let's say, relative equal lows, relative equal highs. That's where retail trader or uninformed money is going to refer to as support and resistance. And so we'll be targeting those levels essentially. So for example, here you have relative equal lows. Those are going to be your target. Here you have relative equal highs. That's going to be the next target after this target's met. And then it'll start generating new liquidity. And whenever it generates new liquidity, you'll hear the terminology engineered liquidity. And that's because we believe, once again, that the markets are run on an algorithm. And so this algorithm will essentially create these patterns on charts that will lure the majority of traders into the wrong direction. So that's called inducement, inducing traders into the market to build up liquidity so that they can profit off of majority of traders' losses, right? So for example, if smart money, let's say smart money is trying to make $1 million, then you're gonna need, let's say, thousands of uninformed money to give up their money to smart money whenever they are trying to make money. Remember, trading is a zero-sum game. And so that means if smart money is making money, that means there's a lot of uninformed traders that are losing money. And that works the same way, vice versa. If a lot of traders like us that we're trying to be the top 5% of traders, profitable traders, whenever we make money, majority of the time we're not really making money from smart money themselves because they're probably making tons of money from majority of traders that are losing money. However, when we make money, we are still grabbing liquidity from anyone that took a loss in the market. So here, once again, just going through it, how to spot it on a chart. Trend line here going lower. So you can see this subjective dotted line I've drawn here. It touches it once, right? And so you can start drawing that line out and see if it touches again, respects it. And then the retail crowd will assume that this is a resistance level. And so every time it touches that line, they expect price to go lower. And so what will price do from there is it'll run straight through these highs. And so you can use it as a support and resistance. So once you flip a resistance level, it becomes a support level. So if you drew out this line even further, it supports from this line again. And then that will be generating even more liquidity because now you have retail traders buying down here. These equal highs once again being run out. These equal highs being run out. Every high and every low in the market is liquidity. And so think of each high and low as a magnet for price. And the more highs and the more lows you have stacked on top of each other, they will become a greater force. And they will be magnetized until they are traded into, for example. And so ultimately, once you have these lows that are all stacking up on top of each other, this is the greatest drawn liquidity at the end. And drawn liquidity just basically means where the market's going to. So you'll hear drawn liquidity a lot as well because people are asking, what's the drawn liquidity? Meaning, where's price going right now? And so here you can see there's one low right here that was never traded into. There's two lows that were here that were never traded into. 3 lows, 4 lows, 5 lows, 6 lows, right? And now understanding that there are 6 lows here means that there are 6 pools of liquidity all on top of each other, right? And so ultimately you're going to be looking for this low because price is going to run straight through it like a knife, like a hot knife through butter, essentially. And so now I wanted to kind of add on to that AMD schematic you guys learned in market structure. And so this is why accumulation will usually result in manipulation and then distribution, is because that accumulation phase is building up orders on both sides of the market. So for example, when you have that consolidation, right, the retail crowd majority of the times view this level as support. And so because of that, that means there's orders start to really stack up because they're above each high. And then there's going to be a lot of buyers at the lows. And so you can see how this is called accumulation, is because it's pretty much just stacking orders on top of each other. And so now whenever this happens and we've created accumulation, that means there are a lot of pending orders stacked on each other, meaning that they are pretty much ripe for the taking. Smart money is going to take advantage of these orders in order to move the market, because in order for them to sell, there has to be willing buyers. In order for them to buy, there has to be willing sellers. And so what perfect way than to accumulate, chop people up in this back and forth price action, and then eventually move price out of it, grabbing all of the sell side orders, right? And once the sell side liquidity is taken, this down move right here is often referred to as the manipulation leg. Why is it the manipulation leg? Because this is the false move before the real run in price. And so you have that accumulation, manipulation, distribution, remember. And so why is this manipulation important? Is because this manipulation specifically will now induce lots of traders to get into the market short, building even more sell side liquidity. And so typically there's something called a breakout trader. And what breakout traders do is whenever a support or resistance level is broken, they will, buy whenever a resistance level is broken, expecting it to expand higher, or they will sell whenever a support level is broken and that they expect price to expand lower, right? And so here, once that occurs, there's going to be a lot of sellers flooding into the market once again as price goes lower because there's something called fear of missing out. That's called FOMO. I'm sure I introduced that before, and that's where the psychological part really screws people over because they get into a move before it's confirmed to continue in their favor, right? So you can start to see how all these orders are starting to stack up. I'll delete these ones right here because these are wiped out now by the time price trades lower into them. And now we're starting to stack even more buy side liquidity. And so once again, what else would be more perfect for smart money to offload their positions to willing sellers, or sorry, willing buyers, because here they're going to be buying back their positions. So that's what smart money is exactly going to do, is they're going to reverse price, causing the real move of the market, which is the distribution. So you have your accumulation here, pending up those orders, sweeping one side. So in this case, it's a bullish example, accumulation, manipulation into sell side liquidity first, and then you're going to be targeting that buy side liquidity, right? And so this is going to be the ultimate target after this manipulation. And so you should see if you are in the buy side of the curve at this point, right? Buy side of the curve at this point, then you should be seeing lots of speed and volatility through these orders specifically. And so whenever you see me in my execution videos or my lives and I say I want to see speed past these highs or past these lows, it's because I want to see that we are confirming we are within one side of the curve. So whenever we trade below sell side liquidity, and let's say we're in the buy side of the curve right now, and so I want to make sure that we're only grabbing liquidity as a manipulation, and then we will see speed and volatility past previous buy side liquidity if we're in the buy side of the curve. Vice versa, this would be buy side liquidity first, right, as the manipulation, and then this would be the sell side liquidity. And you would want to see speed and volatility past sell side liquidity if you're in the sell side of the curve. So it's actually quite simple to remember. This is sell side of the curve equals look for sell side liquidity, right? Very simple. Buy side of the curve equals look for buy side liquidity, right? And it starts to make a lot of sense once you put it into this context, right? And so one thing I like to tell my students is whenever you're in the sell side of the curve, look for sell side liquidity and bearish PD raise. Vice versa, whenever in the buy side of the curve, look for buy side liquidity and bullish PD raise. It's really that simple, right? And so what a market maker model will now look like after understanding all three components of the fundamentals is you have your order, and then you have your distribution, phase one, distribution, phase two, smart money reversal, accumulation, phase one, accumulation, phase two, right? And then you're going to be targeting buy side liquidity. Sorry, my drawing is quite squiggly. So that orange consolidation, that's buy side liquidity, right? This first stage of distribution, that's buy side liquidity. This second stage of distribution is buy side liquidity. And so whenever you're on the buy side of the curve, you want to be referring to buy side liquidity, right? And then you're going to be using bullish PD rays. For example, let's say there's a bullish PD ray here and you had a wick into that bullish PD ray, then that's your accumulation, manipulation, distribution. Same thing here, accumulation, manipulation, distribution, right? Vice versa, if you were in the sell side of the curve, you're only looking for sell side liquidity. So you have your original consolidation, accumulation 1, accumulation 2, smart money reversal into the sell side of the curve, distribution phase 1, distribution phase 2. And so what is accumulation phase 2's low? It's sell side liquidity. Accumulation phase 1, sell side liquidity. Original consolidation, sell side liquidity, right? Accumulation, manipulation into a bearish PD array, distribution. Once again, accumulation, manipulation, distribution. And you're referring to that bearish PD array whenever you're in the sell side of the curve. So that makes it a lot simpler to look at market maker models. And so now hopping into the charts themselves, I wanted to show you guys, some examples of why we like to target trend lines and support and resistance levels. So here, I'll just start off with over here, all of these equal highs. You can see that you have many, many equal highs resting untouched. And so here you have 1, 2, 3, 4, 5, 6, 7, right? They're all untraded into. And so you're going to refer to all of this as pretty much one big liquidity pool. Remember, going back to the trend line, you can use your trend line to identify that this is a level that the retail crowd will be referring to as support and resistance. So every time it touches this line, they're going to sell. Touches this line, they're going to sell. Touches this line, they're going to sell again, right? And down here, same concept. These equal lows down here, 1, 2, 3, 4, 5, 6 lows, all untouched. People are looking at this as support. This is resistance up here. And so here they're expecting once price trades into it, it's going to go higher. In this case, because remember, accumulation, right? So let me just make this as obvious as possible for you guys. Accumulation, manipulation, and distribution, right? And so here, what smart money is doing is they're going to be accumulating orders on the highs. So now you know there's a lot of liquidity resting above this high, right? Lots of buy side liquidity. And then at the low here, there are sell side liquidity because it's a support level, supposedly. And so here, once price trades into it, people are expecting for this to support price. And so they're buying, they're constantly buying here. So let's say they're bought here and then they get stopped out. All of the people that have their stop losses resting below these lows, they're stopped out, meaning they just decide to cut their losses, just like the phone analogy, right? They decide to cut their losses and call it a day. Well, on the flip side, there's a lot of people, once, let's say this candle closes below these lows, they're like, oh, market structure shift. So they decide to sell. And where do they put their stop loss? Above these highs. And so, continue lower, now you know there's a lot of sell orders pent up here, especially with that resistance level earlier that we drew out, right? So here, I'm sure you get the idea. There's a lot of orders where everyone's just keep on trying to sell. And so they target some absurd target down here, right? And then the real move comes into play, which is to raid all of this buy side liquidity as well. Raid pretty much just means trade into, right? That's about what it means. So you'll hear me say raid liquidity, trade into liquidity, grab liquidity. It all means the same thing. It just means price trades into a liquidity level. And so here, accumulation, manipulation, and distribution higher, right? And so as price begins to trade higher, what are we looking for? Well, in this case specifically, it's a special case where at all-time highs. So you can't really refer to any buy side liquidity. So here you just be looking at bullish PD raise. Until when? Until you have a change in the state of delivery, or you're changing from buy side of the curve to the sell side of the curve, right? And so in this case specifically, if you were in the sell side of the curve now, what would you be targeting? Well, in this market maker model, I'm sure you see the market maker model now since I add this curve here. I'll just circle it really quick. So you have your original consolidation, accumulation phase 1. You can call this either your accumulation phase 2 or smart money reversal. Smart money reversal was up here for me personally. You have distribution phase 1, distribution phase 2, right? And then we run out that original consolidation perfectly. So with that now being clear, when you're the sell side of the curve, you're going to be targeting sell side liquidity. So where's your sell side liquidity? Well, here's some swing lows. Here's your swing low from the accumulation phase 1, accumulation phase 2, right? And ultimately, this is your original consolidation right here. That gets ticked out pretty much. And whenever I say ticked out, it means that price just barely traded into it, but still traded into it. That's what it means. And so, once again, one thing I want you to pay attention to is my mind already automatically sees this. As price was trading higher in live time, my brain was already, keeping this noted in my brain. And so if this is the trend line people are buying off of, just imagine how much money is pending down here, right? And so when we change the state of delivery or change from buy side to sell side, we're going to be targeting those pools of liquidity. And you can see this happen in price. Whenever we take out a significant pool of liquidity, price either accumulates or retraces. Or in this case, from your IPTA lecture, it either consolidates or retraces. And now you're starting to understand why it retraces and consolidates after expansion, because the expansion is usually to a liquidity pool. And so once you grab that liquidity pool, you expect a small retracement or consolidation. Why though? Well, if everyone is selling, for example, let's say the algorithm is selling off a lot of orders to push price lower, then once we get into a liquidity pool, it's buying back orders, right? And because it's buying back orders, it's going to push price higher. What does this up move do? It induces traders to buy, right? Because they think price is going to continue higher from here. And so they build up even more sell side liquidity for the next run lower. So here you can see there's liquidity resting over here as well. Once we trade into it, we accumulate, manipulate higher, and then distribute lower, expanding lower. And so what happens once we take the rest of the sell side liquidity within this market maker model, smart money is buying back their positions, right? And one thing I want you guys to note is that whenever liquidity pool is taken out just by a few ticks or a few points or a few pips, depending on whatever you trade, let's just say a few dollars. If it's so close like this, how it just barely trades right below it, that to me does not count as a purge of liquidity, to me, this looks like equal lows still. And so I will still refer to this as equal lows because here there is probably a lot of orders still resting below here because I'm very confident that there are a lot of orders resting below that specific swing low because people put their stop losses even further below that. And so I think that right now, because it's live price, I can't really show you guys, but maybe say 2025, you guys will be able to determine whether I'm right or wrong. I'm sure that this liquidity pool will be purged once again, right? So this is going to be the next target, the next macro target, in my opinion. And so, yeah, that's pretty much what I think. So that's all for this lecture. And as always, I hope you find this insightful. Make sure to go into your own charts and look for, trend lines of your own. So once again, just support and resistance lines and try to look for those in your own charts and see how price reacts to each and every one of them. The higher quality lecture will be recorded very soon, so sit tight and it's coming. It's just I need to get these temporary lectures out first. But yeah, on that note, as always, have a great day.